We've been covering this study on financial wisdom and folly, which means foolishness. And I know I have participated in some financial foolishness that I'm going to take those lessons learned and share them with you all, which is what I've been doing. So I think I started covering last week the 7 baby steps from Dave Ramsey. And most of these financial advisors that are popular, Dave Ramsey, Crown Financial, which is also supposed to be, Christian, and even a lot of these other ones that are secular, like Suze Orman, they all basically preach the same thing. They all basically tell you the same thing, the same traditional financial planning that is, a lot of which is a really bad idea. So we're gonna get into a little bit more of that. I think I left off on baby step 3. So Dave Ramsey has 7 baby steps, and baby step 3 is to save up 3 to 6 months of expenses. That's more, and that's more for anything, emergencies obviously, or if you lose your job or anything like that. That's not a bad thing to do. Obviously, it's not a bad idea to do that. Part of the issue here is, how do you accomplish this in a way that doesn't prevent you from still taking advantage of good opportunities to invest in or things like that. And so, because the recommendation here, at least from Dave Ramsey's perspective, is to put this money in like a money market account and have it just basically sit there, and you can have it, use it whenever you need it, which is only meant to be for emergencies, of course. It's not meant to be used for anything else. And so this is something that we started to do, that we actually did ourselves. But then I started learning more about how utterly unsafe and horrible banks are, right? And I've been talking about that this past couple studies and everything, that there's a big problem when you have, a big chunk of money, because 3 to 6 months of expenses, that's a significant amount of money, right? That's not chump change. And so when you have that much money in a bank, and banks, like I've mentioned before, when the lockdowns hit, and we have to be careful with our vocabulary, right? It wasn't when the pandemic hit. The pandemic was a scam, right? The lockdowns were locked down because of government overreach. And so, but when that happened, the federal requirements for banks to have money in their reserves was dropped down to 0, meaning they didn't have to have any of your money in the bank or available to give to you if you try to pull it out. And then, not too long ago, they raised it up to 20% again, which is causing many banks to shut down. Many. And a bunch of banks have been closing because of this. And this is one thing that really started to get my attention when I started listening to Dr. Kirk Elliott, and he's a precious metals dealer. I highly recommend that you check him out. He's got a lot of good stuff. I found out about him through Alex Jones. And so I got really uncomfortable with having money in the bank, because I was finding out more about how banks are very unstable. They're not safe. They're unsafe. It's probably the worst place to put your money is a bank. Okay, and the problem, again, is because banks are federally controlled. The feds raise the rates of reserve requirements for banks. It's like the federal government controls the banks. They should not be allowed to do that. Just like they shouldn't be allowed to print money, to create currency, or to print currency. And now they have control of banks because of the FDIC. That's part of how they control banks, which is that's not. Supposedly your money is insured up to $250,000 in a federal bank, and pretty much all banks are that way. All banks are like that. They're federally controlled. The problem is that so many banks have already shut down now that FDIC fund to reimburse you if the bank, for whatever reason, can't pay your money, give you your money, that money has run out completely. So there's no more FDIC insurance for your money. So the money that's sitting there in your bank, it's very likely that most of it is not even in there, and because the banks will loan it out, they will take it and invest it and try to loan it out and use it for mortgages and loans and stuff like that. So this is where the precarious situation that the financial system is built on a foundation of sand, right? And so that's why I'm really wanting to stress this to you all, to make sure that you're very careful with what you put in the bank. And then there's the problem of, I think this happened in Canada, when the truckers, I believe, were protesting the lockdowns, and they garnished their wages. They garnished their bank accounts. The government just took the money right out of the bank accounts, or they froze them, because, again, that's a system where the government controls the banks. So this is a situation that none of us obviously want to be in, right? And there's convenience to having a bank. We're all used to having banks and a checking account and a savings account, and the whole thing. And we're in a situation where you can't completely get out of the banking system necessarily. Maybe you could, but it's just not as convenient, right? It's just it's a lot more work to do things that way, and it's worth doing if you can. But we haven't completely gotten out of the banks, but we've taken most of our money out of the bank. So we only have what we need to use for the month, basically. Just whatever we need to use for our short-term saving stuff and our monthly expenses. That's basically it. And so this is the problem with one of the big problems with Dave Ramsey's recommendations, is that he doesn't give you this big picture perspective of economics, and the government should not be controlling money and banks the way that they do, because they're the ones who cause all of these problems, all of this inflation and all of this financial disasters that have been brought down on our nation. The Great Depression, all of those things were caused by the government. Those are all government problems. It's government corruption, and that's not how banks are supposed to operate. Banks, but also governments. And so that's why we got very uncomfortable with having our savings just sitting there in a bank, basically waiting to be taken. And so that's why we ended up making that decision to take the money out of the bank and look into putting into precious metals instead. So that's something that I would highly recommend that you all look into. Dr. Kirk Elliott, very much recommend that you all check him out. I've posted his link several times on MeWe, on the church group, and it's just a much safer, a much better approach to having something that won't lose its value. Well, apart from that, because I didn't even get to the problem of the American dollar itself is about to expire. right? The value of the dollar has all but collapsed. And you see the world economy now trying to move away from the dollar, and the instability that the dollar is creating because our government is so unstable and out of control. Because they keep printing money and more money like crazy. So we need to be aware of these things. It's important to be aware of these things and to be responsible with our livelihood, with our finances, so that we don't get taken advantage of, right? And with some good planning with respect to these things, we could be well prepared for the disaster that is already before us as a nation. And one thing too is that with respect to that, it's kind of like the story of Joseph in Genesis, right? The story of Joseph is where there was going to be a famine in the land in Egypt for 9 years, right? And so, but then they were able to prepare for that famine by storing up food in advance so that they could weather out the drought, the storm, and be okay. And this is what it basically is that I'm trying to get us to do. To be prepared, right? Be prepared, have a plan to be able to secure what you have, what you need, and not rely on the government. Okay? We need to not rely on the government as much as possible, because the government is not reliable. They are not trustworthy. They are criminals. And we are living out their criminality every day. You know, there's a guy, I think a French philosopher, an economist, I think. Well, he was a philosopher. But his name is Frederick Bastiat. And Frederick Bastiat, or Bastiat, I don't know how you pronounce it, but he wrote a book called The Law. And very good little book. And there's actually a Tuttle Twins episode based on that book. They also wrote a book. The Tuttle Twins series, by the way, that's like it's a series of books for kids, for children, that teach kids like basic free market, conservative free market, capitalist principles. Very, very sound conservative principles that line up with Scripture. The only thing that you have to be careful with them is that they are hardcore Mormons. So just be aware of those things. But this thing about, so Frederick Bastiat, he talks about something called legal plunder. Legal plunder. And legal plunder is basically when governments take advantage of you. They take your stuff for them, and they use it for themselves illegitimately, or they distribute it to somebody else who doesn't have money. That's basically socialism, and it's a very corrupt form of government. So the issues there in the government has become a bunch of treasonous pirates. That's basically what they are, right? They engage in this act of legal plunder because they take your money by stealing it, essentially, but it doesn't look like it because it's the government doing it. So it's like, okay, well, the government, it's like, it doesn't matter if it's the government doing it. Obviously, the government can do wrong things, can do wicked and evil things. And in the Bible, God judged many nations for being evil, for evil governments and engaging in acts of sin and idolatry and war and all of these things that were sinful. So that's why we have to, this is something that I started to learn some years ago, and recognizing that I became so very upset at the fact that I just sort of listened to whatever Dave Ramsey was telling us and didn't properly examine it with Scripture and with other wise counsel. Right? And that's the big problem, is that you have to be careful with who you trust. You have to be very, very careful with who you put your trust in. Because now, sadly, I listened to this guy for many years, and some things were helpful, but some things really hurt us. And they set us back significantly. So, and one of the ways that, in this really, I think, to really drive this home, and I should have brought my books with me for show and tell. Next time I'll bring Nelson Nash's book. Oh, great. Yes. Awesome. Thank you. So I mentioned Nelson Nash's book. Thank you. I mentioned Nelson Nash's book last time, Becoming Your Own Banker. This is it. Highly recommend this book. What I did was I ordered it was like a starter set from the Nelson Nash Institute. They have like an $80 set where they have Nelson Nash's like 2 or 3 books, and a couple of other books that talk about the economy from a more Austrian perspective, which is a more conservative and more biblically consistent view of financing or money and economics. And so and I mentioned, by the way, that if you talk to the guys from Banking with Life, with James Nethery and their office, and if you try to get a policy with them, they will require you to read this book. So, and it is a very good book. It's very much worth reading. But here in this book, it's extremely fascinating because this is really a study on human behavior. And it's also a study on going with the flow of financial advice and having it fail miserably, and going with non-conventional ways of thinking and realizing how much better it really is. And this is one of the things that I wanted to really bring out today, because you all know Dave Ramsey, right? Did anybody go through his financial peace university? Yeah. So with Dave Ramsey, he had become a millionaire, I think, early on in life, and then he lost everything. And he had to declare bankruptcy when he lost all of his money because there was some real estate stuff going on, I think. And so he had to declare bankruptcy. And as you know, bankruptcy, that's a drastic, last resort decision where you're basically, it's on your record for 7 years, depending on what kind of bankruptcy you declare. But bankruptcy, that means you couldn't pay off your debts. That's what it means. You couldn't pay off your debts, and so you basically stuck, you either have to liquidate everything you own in order to pay off whatever debt you can, and then you're sort of just stuck paying off, you're sort of in a sort of a financial limbo for about 7 years roughly. But the interesting thing was that something very similar happened to Nelson Nash. When there was a time, he was also heavily invested in real estate. He became very successful because he was following all of this financial guru advice about real estate. And at one point, I think it was in the 80s, the government drastically raised interest rates from one year to the next, drastically, and soared the interest rate. And that took a lot of people by surprise, especially people who were heavily invested and had a lot of debt in real estate, because then people started to lose their homes and their mortgages, and they couldn't pay them and all this stuff. And so all of this has consequences. Irresponsible lending and financial practices has consequences. And so he became instantly $500,000 or more in debt within just a matter of a year, because of the interest rates changing so high. But something interesting, very, very interesting happened with Nelson. Nelson, he didn't declare bankruptcy. Instead, he realized that he was already paying a lot of premiums, high premiums, into a life insurance policy, and he realized that he was able to tap into that capital by taking out policy loans and things like that. And so he took advantage of that life insurance policy in order to pay off all of his debts. And that's how he was able to climb out of debt without ever having to go declare bankruptcy. So it's pretty remarkable. It's pretty amazing that on the one hand, you have Dave Ramsey, who's famous, probably the most famous money guy, even in not necessarily Christian, even just everybody knows who Dave Ramsey is pretty much. But his way led to bankruptcy, yet Nelson's way, he was able to get out of a huge amount of debt. I mean, we're talking at least $500,000. That's not chump change. And that was back in the, 80s? That's even worse now, right? So the way he did it was by applying these infinite banking principles. This is why it's so important to understand these things, because they're so powerful. They are so incredibly powerful, and they help us to manage our finances and control our capital wisely, to give us more control over our money. Right? Because, the life insurance company, those agencies are not banks. So they're not regulated and controlled like banks are. There's no Federal Deposit Insurance Corporation attached to the life insurance companies. There's no regulation of that extent, of that sort. Because life insurance companies operate with their insurance. They deal with insurance. And insurance is a different kind of thing. And that's where we get a lot of the advantages of life insurance, especially mutually owned, dividend-paying, whole life insurance. Now, there's a whole bunch of other types of insurance, and most of them are pretty much scams, okay? Variable whole life and universal life, and there's all kinds of there's all kinds of these gimmicks that people will try to sell you. And a lot of those things are just rip-offs. They're not wise. They're not good ideas to get into. But this kind of life insurance you can use to as a way of creating for yourself your own bank. And it's extremely powerful. So powerful that the way Nelson Nash took advantage of it, he was able to get out of debt without ever having to declare bankruptcy. So that's really powerful stuff there. And something that I want to really drive home here as well is I wrote a book review of this book, and I shared it on the MeWe group. I really do recommend that you check this out, because it's like, honestly, how do you describe this? It's almost like the best thing since sliced bread. It's better than sliced bread, okay? This stuff is amazing. And I want to read my review of this book. Okay, so it says, phenomenal, paradigm-shifting, life-changing book. Get it, read it, apply it. Don't listen to financial gurus, right, quote unquote, like Dave Ramsey on life insurance, who misled me, who not only don't understand, but apparently refuse to be corrected regarding the amazing power of mutual, whole life, dividend-paying insurance policies, which you can use to finance purchases and actually earn interest on policy loans. Now, so this is a little bit misleading here. You earn interest on the money that you have put into the life insurance policy, okay? The reason you can continue to earn interest is because you're not taking the money out. Because one of the lessons that you'll learn here is that interest, you're either earning interest or you're losing the opportunity to earn interest when you when you use your money to pay for something. So, but when you take out a loan, your money stays intact and it's still continuing to earn interest. So, in addition to having more control over the repayment, as opposed to paying someone else the interest or foregoing the opportunity to earn interest by putting it in a sinking fund, a savings fund like Dave Ramsey recommends, that's what I talked about last week, to start and fund businesses and even create loan or leasing type businesses to generate a passive source of income, tax-free, eventually to live off of completely once the policy matures into retirement age, and to still give a substantial death benefit to your beneficiaries even when you die old. Whereas the term life that Ramsey recommends becomes prohibitively expensive by the time you're more likely to die. And more. Listen to this, okay? This is a powerful solution to the failed, unbiblical government banking system, savings and retirement accounts, welfare schemes, all the way from the FDIC to 401ks to 529s, which is a college savings account, Social Security, Medicaid, Medicare, etc., on and on. All these government accounts and plans are just ways of bandaging a problem that they caused. Okay? It is a powerful means of setting up both yourself and the next generation, your legacy, for financial success and freedom. For a good man leaves an inheritance to his children's children, and the wealth of the sinner is stored up for the righteous. That's Proverbs 13:22. Amen? So that's why I really want us to take hold of this and take advantage of it. Now, I know I'm saying all this good things about it, right? But there are caveats. There are qualifications to being able to do this, okay? There are certain things that you have to do in order to make this work properly. One of the things that you have to be able to do is to save money, right? Because in order to create a banking system, you have to pay premiums. And that's the big question that they're going to ask you is how much money, the big question that they're going to ask you when you try to open up a life insurance policy in order to do an infinite banking system, they're going to ask you, how much premium are you willing to pay? How much premium are you willing to pay? Because your premium, how much premium, you're going to get out of it what you put into it. Okay, right? So if you don't put a whole lot into it, you're not going to get that much out of it. So the more you're able to put into it, the more you're able to save your money and set it aside and have it work as a sort of sinking fund, but better. It's better than a sinking fund because your sinking fund will stop earning interest the moment you use it up. Right? That's the problem with the sinking fund. The minute you take the money out, it's gone. You're no longer earning interest on it. But when you use a infinite banking system through a whole life insurance policy, you never take the money out. You get a policy loan out instead. And you pay for things with policy loans if you need to, instead of taking money out and losing the interest on that money. Okay? So that's what makes this so powerful. And when you understand this principle, that's the big thing, is that you have to be able to save money as much as you can so that you can put it into a banking system for yourself and your family to take advantage of and to use. And it's extremely powerful, like I already said. There's so much control because when you take out a policy loans are unstructured. Unstructured loans means there is no repayment plan, there's no terms, there's no conditions. If you stop paying it or if you don't pay it, you're not going to get, your wages garnished or your bank account frozen or your assets taken away or your house taken away or none of those things, because the life insurance company will simply take it out of your death benefit that you're paying for. It's very simple. So your collateral is your death benefit. that's what's going to be used to collateralize your loan. So you can only take out money that you have saved up in your life insurance policy. So it's a system that's much sounder because it doesn't allow you to borrow beyond your means, because it's only what you paid into it, right? And the life insurance company is not going to they don't take risks. Life insurance companies are the most conservative types of companies that invest in certain things that are long-term, because they are long-term players. They don't try to go for these schemes and stuff, that's what the Bible says to do, right? You shouldn't be looking for get-rich-quick schemes. We should be looking for long-term wealth, accumulation of wealth, and building up of our capital and resources. That's what the Bible says, and that's exactly how this system works. The system is designed to work for years over time. You build it up gradually over time, over the years. And it's incredibly powerful. This is just a sample of what to look forward to. But again, you have to be able to use your money, save your money wisely, and practice good budgeting principles like we talked about last time. The first time is knowing how to budget wisely your money, and you need to tell your money where to go, right? Tell your money where it's going. Okay, I'm going to allocate $1,500 for groceries. That's a real number for us, okay? And some of y'all may not even know how much money you spend on groceries or on gas. You may not even know, and the numbers might shock you. So you need to be able to track your expenses and budget, because you're probably spending money in areas that you don't need to be, or it's just not necessary, and you can probably find much better ways to save money on by making simple changes in a lot of cases. One of the things that I do appreciate about Dave Ramsey is the way he advocates for insurance. There's different views of insurance. Some people believe that insurance is sort of like makes you a target. So if you have a lot of insurance, it sort of makes you more likely to be, if you get into a situation and they find out that you have a lot of insurance, and they're going to try to take it out of you. Other people, like Dave Ramsey, they recommend getting maximum liability insurance. Get the highest insurance that you can afford, and in order to not have a situation that you don't expect, and then you're stuck having to pay for it, right? So I think biblically speaking, it's probably a better idea to have insurance because it's a way of planning. It's really just a way of planning ahead, and planning for unexpected things that could happen. Because if you get in a car accident or something, well, first of all, you're obligated, you have to get insurance, right? If you're driving around with no auto insurance, you're riding dirty, and if the cops pull you over, you can go to jail for that, right? That you could get into serious trouble. That's illegal, right? So, but regardless of that, it is good to have those things, because if you could be liable for things. People could accuse you of something, or you could be liable for certain things. And if you don't have the money, you could be stuck in a situation where you might have to declare bankruptcy, or you might have to, forego all your assets, whatever the case may be. So it's just wise to be prepared, and insurance is one of those ways to prepare. But a smart concept that Dave Ramsey recommends is when you get auto insurance or renter's insurance or home insurance or things like that, he recommends getting high premium insurance. Because when you get high premium insurance, the rates are lower. So high deductible. High deductible insurance, because when you have high deductibles, the rate of premiums are much lower. So your insurance will be much cheaper if you have higher deductibles. So you only pay, so if you set like $1,000 deductible on things, because going back to his step one, you should have the $1,000 at least saved up in case you need to use it, and for emergencies like an auto accident or whatever, right? So that's the strategy. There's a strategy behind it. And so if you save up money, but better yet, if you put it in a life insurance policy, you can have the capital saved up there that you're paying into through your premiums, and you can get insurance with a high premium on it that's significantly cheaper because getting a $1,000 deductible is much more affordable. And so that's something those are things that you can do to take advantage of, because insurance can get extremely expensive. You know, and that's another reason not to get big, fancy, expensive cars, like I know most of you have, right? JK, right? So, but you have to be like this is part of being wise with our money. When you get a fancy car, a new car, it's more expensive to insure. They are a lot more expensive to insure as opposed to getting something older. I'm not talking like 20 years, but typically, honestly, the older cars tend to be better. These new cars can get hacked so easily. They have computers on them, and downloading stuff on the 5G, and they got radiation beaming at you. I mean, there's all kinds of stuff with these new cars. And these cars are also more expensive to repair because they've got all this fancy machinery that the older cars don't have, right? So just be aware of these things. It's so much cheaper to buy something used, gently used, right? Have a good mechanic that you trust, and look for mechanics that will educate you, right? Not the ones that'll just try to take advantage of you, but will educate you on how to understand the inner workings of your car so that you know how it works and how to look for problems and what things to look out for. So this is just the way things, a more expensive house is more expensive to insure. It's just the way things work. And so that's part of us being wise with our finances and not reflecting worldliness. Now, I'm not trying to be this like, you need to forsake everything you have and sell it all and become a beggar, okay? I'm not saying that. That's not what Jesus meant, right? I'm not saying to do those things. I'm just saying to be wise with your finances. If you can't afford those things, don't get them, right? Because they're going to just be a burden on you, and that's going to give you anxiety and health problems, and that's going to affect your health. And now you got medical bills that you're looking at, and so just be wise with your finances. Not to say that you can't get those things, but you're going to pay a cost, a significantly higher cost that, honestly, why would you? Why would you? So these are all just so many basic things to look at. And that's why those are some things that, that were helpful from going through Dave Ramsey's system. It's just that so much of it now I realize is really honestly garbage. It's bad advice. It's very bad advice. Having your money in banks, that's one of the worst things you can do, like I said. So that's a big thing to be aware of. Now, another thing is so his baby step number 4 is invest 15% of your household income into Roth IRAs and pre-tax retirement plans, okay? So these are the taxing accounts and systems that the government has set up for you, for us, for many of us who have an employer, and they offer a 401k, right? And they some of them even match your contribution up to a certain percent, like 2% or 3% or whatever. And it may look like a pretty good deal. Like, okay, well, yeah, they'll match me. So if I invest, whatever, if I invest a certain percentage, they will even match your contribution to your 401k. Now, the only problem with that is, of course, it's heavily government locked down and control. And once you put your money in there, once you put your money in a retirement account, can you take it out? Well, you can. You can, but what happens to it when you take it out? It gets taxed. Massively taxed. Right?
You don't get taxed going in, it gets taxed going out.
It gets taxed going out.
Which is at the higher rate.
Which is right, exactly. That's what makes it worse, right? Because taxes are they going up or are they going down? They're always going up, right? So when you when you invest money into these accounts, not only will you be taxed when you take them out, but if you take them out when you're not supposed to, if you take them out before you reach 59 and a half years old, which is like your entire life, your money's stuck there. You are basically putting your money in a prison, hoping that it'll still be there by the time you get old enough to get it, because they will tax you heavily. They will fine you. Not just tax you, but they will fine you if you take it out before you reach retirement age. So these plans are they're this like they have this appearance of saving and wisdom, but the reality is it's a scheme. It's a scam that the government is trying to do to help make up for the problems that itself is causing, that the government itself is causing. Right? So, yeah, you have a question?
Well, you can't take it out? Or like,
You can take it out. You can take it out, but you're going to have to pay taxes and it's going to be fined. You have to pay a penalty. If you don't want to get penalized, that's what happened with my dad. My dad, when we fell on hard times, he had a 401k and he ended up taking the money out, heavily penalized and taxed, and used it up, and now it's gone. There's nothing there. It's a
prison. What did you mean by that?
Because you can't take it. You could take it out, but it's like there's so many strings attached that you're not really taking it out because you're losing so much of it, right? And there are ways, like if you've already invested a lot of money into a 401k, there are things you can do to preserve the wealth that you've built up there if you're already stuck with it. Because if you can't take it out, because that's the problem, you can't take it out unless you want to pay all this fines to the government for having done so before you were allowed to or should have.
That's what happened to me. I took out about $400 from my 401k, and then when I did my taxes, they actually had to pay 2%.
Yeah.
In Virginia.
Yeah.
I did $1,000 of my, when I was 16, I took out $1,000 from Albertsons on the 401k, and I don't even know.
You got taxed.
Oh yeah.
It probably got, it was like,
Yeah, you didn't get the full amount.
I got taxed like a few $100s.
Yeah.
You got like 600 and they kept.
No, I got 1,000. I had more than 1,000.
Yeah. So you're paying a heavy amount of fines and taxes on those things, and that's part of the problem with having these schemes. Yeah.
You're not building interest anymore when you use it.
Oh,
It's
that
no longer
yeah.
sitting in
Oh, that's
there
another
waiting
problem.
for
Yeah,
money.
of course. You can't.
It breaks the-
You're not earning interest anymore, right? And one of the things you can do if you do have money saved up in a 401k is you can have it backed by precious metals. And Dr. Kirk Elliott's team, their office, they can work with you on that if you want to have precious metals to back up your 401k, so that it's not just relying on the stock market, because the stock market is so inflated. At any point now, it's going to absolutely collapse, along with the real estate market. So they have done an amazing job of expanding the bubble without popping it. But boy, are they they are really stretching things. And so we're like, the market is basically a Frankenstein right now. It has the appearance of looking vibrant and stuff because they're pumping so much money, they're printing so much money. But man, you really have to be careful. And so part of what you have to also, so this is just one of those things that you want to watch out for. And then that's the other problem with retirement accounts, is that you can't keep the account intact. So after a certain while, when you are retirement age, they will do mandatory withdrawals for you if you don't take the money out yourself. So they will force you to take the money out of that account. So now, you're no longer earning interest on it. It's a total scam. Total scam, okay? This is so disgraceful that people like Dave Ramsey and all these financial gurus are pushing these schemes. It's a scheme. Pushing these schemes on people without really having them understand what you're getting yourself into. Because when you put your money in a life insurance policy, you can still tap into it and take policy loans out of it while it's still earning interest. And you're paying into it, and not only that, you're paying into it so that it actually becomes passive income to the point where you can completely live off of it if you pay enough into it. This is the amazing power of having a life insurance policy like that. And not only that, but when you pay enough into it, again, you have to pay a good amount. Okay, you have to save good, pay a good amount into it, but if you're able to do it, after a certain while, the policy ends up paying for itself. So you don't have to put premiums on it all the time. After a certain number of years, you start earning dividends that are high enough, that are so high that they pay for the premiums. So the policy becomes self-maintained simply because of the dividends that you're earning back. And then it continues to compound interest. So but then once you graduate, meaning once you pass away, once you die, if you have a good life insurance policy with enough money saved up, you will have left potentially millions of dollars of death benefit to your beneficiaries. And this is another thing that these guys don't understand and don't tell you. You can go to YouTube right now and listen to Dave Ramsey rant about life insurance and about how the only life insurance that's not a ripoff is term insurance. Here's a problem with that mentality. So we've already been talking about whole life insurance and how it's not only not a ripoff, it's a banking system that's almost completely protected from the government intervention and control, right? But not only that, you can also take out unstructured loans, like I said, where you don't have to repay the loan if you don't have the means to do it. You should, because you're losing money because they charge interest on the loan, right? They're going to charge you interest on taking a loan out. So you need to pay it back if you don't want to lose money on your life insurance policy. But you don't have to if you get stuck on fallen hard times or whatever. That's the beauty of it. And there's no repayment plan. You're not obligated to pay a certain minimum monthly amount. You have so much more control because you yourself are your own banker. That's what it is to be your own banker. And none of us are we're so used to being a slave. You know? We're used to being slaves and being dictated by somebody else's terms and borrowing somebody else's money. But this makes it so much more powerful. And now, the other thing is term insurance is only typically good for like 20 years. Okay? And this is where I was saying last week, where most of the time, life insurance companies make a lot of money on term insurance, even though it's the cheapest form of insurance, because only 1% of it gets paid out. Only 1% of term insurance gets paid out, meaning that people who have term insurance don't use it because they don't die within the term that they paid the insurance for. Because you're more likely to die. When are you more likely to die? When you're older, right? When you get older, that's when term insurance becomes prohibitively expensive. If you try getting term insurance when you're 60 years old, it's going to be massively expensive, and you're not going to want to be able to pay for it probably, because the premiums will be through the roof, because they know you're going to die within probably 20 years. So term insurance is almost, and I'm not saying term insurance it is good to get term insurance, okay? Because you don't know what's going to happen. You don't know the future. If you're going to die, I'm talking to mainly people who make income, right? Who make money. If you die, you want to be able to give something to your loved ones, so that they can. And that's something that is generally a wise plan that Dave Ramsey recommends. That you should invest 10 times your income into term insurance, so that if you do die, your beneficiary will receive that amount. You receive it all at once, and you can invest it in mutual funds and get 10-12% return. So basically you've replaced the income that you lost that way by investing it in mutual funds. The only problem is that if you invest in mutual funds, what are mutual funds tied to? The what? Well, yeah, they're taxed, so that income is taxed, but also the stock market, right? So mutual funds are contingent on the stock market. So, and this is the problem with mutual funds again, or any kind of investing in the stock market. The stock market can collapse, which has happened before. Companies can dissolve. So if you have money and you've invested in the stocks on a certain company, if that company goes bankrupt and collapses and dissolves, you've lost all your stock. You have no money. All that money you invested in that company is gone. That's the danger of investing in the stock market. There's a risk there. That's why the beauty of investing in life insurance companies is that it's the least amount of risk, because they are so careful and so controlled in how they manage the finances, because they know that they have to pay you. They have to be able to, they are contractually obligated to loan you the amount of money that you have saved up in cash value on your life insurance policy. So that's what it is so important. This is why I'm talking about, like I was saying in the book review. It's a paradigm shift. It's a total paradigm shift from having a slave mentality and subjecting ourselves to government control and government bondage, which is really what it is. It's a form of government bondage, just like I mentioned pension plans, right? You become a corporate slave to the government or to a company for 20 years, and then they pay you, so they can pay you out a pension plan. And it's like, well, you don't need to do that. You don't have to do that if you have a life insurance policy that you're paying good premiums into. You can make whatever money you want, however you want, as long as it's legal, right? We got to keep it. You got to stay saved, right? You got to keep it legal. But the beauty of it is that it's also tax-free. It's completely tax-free. And even when you get ready to, so when you retire or when you get to that retirement age, you can withdraw money from the policy, or you can continue to take out policy loans and leave your money in there building up interest. Because when you take out money, so let's say, okay, I'm going to retire now. I'm not going to work anymore. I'm going to start taking out $80,000 of my life insurance policy in a policy loan. I'm going to take it out, and I'm going to use it for the whole year for whatever expenses we have. Now, I'm not planning to pay that back. I'm not planning to pay that back because I'm not making money anymore, right? So, and then the next year, what am I going to do? Same thing. Take out another $80,000, or if I need more, $100,000, or if I need less, $75,000. I take out whatever I want, however many times I want. I take it out, I use it, and hey, I don't have to pay it back because my death benefit is going to pay it back. So you taking money out and you live 15 years, right? 15, 20 years, whatever. You're taking money out of your loans, and yeah, the interest is, you're going to lose interest on the loans, but you're still gaining interest on your money because you haven't taken any of it out, right? So some of it might be able to balance out there, or you could also withdraw the money if you wanted to. And if you withdraw the money, it doesn't get taxed up. So what you withdraw does not get taxed as long as it's what you paid in premiums. Once you start taking out more money that is beyond what you paid into it in premiums, then they start taxing it. Okay, that's called the cost basis. But if you take out a policy loan, is that taxed? No. Policy loans are not taxed because they're loans.
So could we take it out and then pay ourselves back?
You could pay it back, but you're not, if you're just, this is passive income, right? So if you're not making money anywhere else, like if you're not making any money, you can't pay it back. But that's the beauty of it. You don't have to pay it back. You just keep taking out the loans and let the death benefit pay for it.
Doesn't run out? Like,
Well, it can. I mean, if you take out a $1 million loan, or whatever, if you take out a massive loan and you don't pay it off, then yeah, you could lose most of your death benefit. But there's a chapter on this book towards the end where he talks about being uninsurable, and he gives you an example of a situation in which they do that. They start taking out money, and again, you don't have to pay. That's the beauty of it. You don't have to pay it back, and it's not taxed. So your death benefit will cover the debts that you don't pay in the very end. And you still give your beneficiaries the benefit of potentially millions of dollars in death benefit, because that's what you were paying for, and you don't lose it. It's not for just a term of 20 years. It's for your whole life. That's why it's whole life insurance. It's insurance for when you die, for when you actually die, and for your whole life. You can use it while you're still alive. That's what makes this so much more powerful and more flexible than just using term insurance. Now, even whole life uses term insurance because they have to put riders on them in order to allow you to pay more money into the life insurance policy without it becoming taxable. Okay? So you'll still have term insurance in there that you can still take advantage of. So in the event that you do die within 20 years or whatever, you still get to pay out some money to your loved ones. That's what's so amazing about this. But again, this is not a get-rich-quick scheme, right? This takes time. It takes years. It takes a certain number of years to build up the capital, build up the cash value in the policy. It takes time, but over a certain amount of years, once you start getting to 5, 6, 7 years, you're going to start seeing some real value there, and the policy will start taking care of itself, and that's what makes it so powerful. Okay, so I can probably leave you with that for today. Any other questions before we wrap up? Yes.
So you can pull out more than you put?
Well, so the way it works is that when you start getting ready to, you say you're later on in life, in a retirement age, right? And you start withdrawing money. You can either take a policy loan, which doesn't take the money out of the policy. It's a loan, right, through the life insurance company. If you take a policy loan out, your money will still be intact and none of it is taxable. The other alternative is you can withdraw money from your life insurance policy. You can withdraw cash from it, but you can only withdraw up to your cost basis, which means the amount of premiums that you paid into the policy. So if you've been paying a policy for 20 years and you paid $500,000 into it, you can take out up to $500,000 without it being taxed on you. Once you start taking more money, withdrawing more money after that, it's going to get taxed.
So you can take more. So you can take more than you put.
You can.
But but not right away.
No, not right away.
You have like around how much would you accumulate in order to?
It all depends on how your policy is structured, how high your premiums are. How all of that is variable. It all depends on how much premium. A lot of it has to do with how much premium you can pay. That's because the really good policies, like if you want a good policy that's going to leave you with millions of dollars when you get later on in life, and you want to take a significant amount of money out and not be able to worry about paying it back or whatever, and still leave millions of dollars of death benefit, we're talking like paying $20,000 a year in premiums. Okay, that's not chump change. That's like $1,600 a month. So this is like paying for a mortgage. But you don't have to pay that much in order to get something out of it, especially if you start early, because the longer you're paying for it, you're paying into it, that compounds and accumulates over time, right? So that's the beauty of it. If you start now, if you start soon, you can start accumulating that wealth, and that interest will compound. But So a lot of it will vary depending on things like that, and how it's structured, and also on your health rating, because it's life insurance. So if you have certain health problems, that's why it's good to look into this now. Because if you get into an accident, or if you get sick, or you get some kind of mortal disease, then you might be uninsurable. That doesn't mean you can't take advantage of this, because you can still insure somebody else, like your wife or your kids or somebody that you have an insurable interest in. You can still do it, but that's something that you have to be be aware of, right? So that's why I really encourage you all to get in touch with these guys, with James Nethery. These guys are really sharp. They have a bunch of good information out there. Very, very well. They really help you to see the problems with the way other people do things, like Dave Ramsey, and even the way other people try to sell you insurance that is not beneficial. So very, very, I'm really glad that my friend, told me about these guys, and because now I'm changing everything in our finances to do this, because it's so much better, stable, and safer, because it's away from the government. That's what makes it so powerful.
Who funds them?
Who?
Who funds the life insurance?
So that's a good question. The life insurance company, what they do is, first of all, through premiums, right? So what you're paying, yeah. But the beauty of it is, when you become a client of theirs, you become a mutual owner in the company. That's what it means when they pay you dividends. So when they pay you dividends, that means you're a mutual owner in the company. You get a certain percentage back of what they made. So, but that's why it's also, when you take out a policy loan, and in a way you're kind of paying yourself, because when you take out a policy loan, you are contributing to the business of your insurance company. So you're making them more profitable. And that's enabling them to pay higher dividends. Right? So there's a nice feedback loop there. Right? So even though you're paying interest to the company that's paying you back dividends. So it's really nice. Yeah. Yes. And so, and a lot of the things that they do extremely conservative, long-term investments, like bonds and things like that. They do invest in the stock market to certain things sometimes, but they invest long-term plans with bonds and things like that, so that they have a guaranteed amount of money reserved for their clients. That is their guaranteed obligation that they must do. So that's why they don't mess around with their money. They don't take out 80% of it or more, like banks do, like all of our banks probably do. They're not taking out most of it and loaning it out and putting it in mortgages, and then we have a financial collapse or a mortgage, real estate collapse, and now everybody can't pay their mortgage. And now the banks fail. And now you can't take your money out. It's a chain reaction, right? Because of this fractional reserve banking, that's what it is.
And me and her, like, to be separate, she can have her own.
Yeah. You can have multiple policies on yourself. You can have some on your wife, on your kids. The only thing is that if you have a policy on your kids, you have to. So like we have 5 kids, right? We can't have one. We can't have on just one. We have to have it for all of them. So that's the trait. You have to kind of, because they're thinking like, what, and I don't know why they're so morose. Because it's like, well, are you planning to kill that child? It's like, no, because that's what I can afford. I just can't afford 5 kids right now. Lord willing, so they don't allow you to just insure one. You have to insure all of them. But you can do your wife, you can do your spouse, you can do really anybody.
But if like her own, or like it would be like
so the way it works is there's a policy owner, and then you can get a policy on your spouse, so that when she passes away, you get she gives a death benefit to beneficiaries that you guys designate, right? But if you get a policy on yourself, if you die, you give a death benefit. So it does matter who the policy is placed on.
So what if we would be in the future, like let's just say 20 years, once we're like 45
Yeah.
We wanted to take some out.
Oh yeah, yeah. No, it works the same way. It works the exact same way.
Together?
It works the same way.
She can take
You
out
could take out loans.
500 grand and I can
Yes.
take out 500 grand.
Yeah, and it's dependent on who the owner is of the policy, but you can take money out. Y'all can take money out, and if you die, so let's say you take out because there's an example in the book that it gives, like this guy gives, he's uninsurable, so he takes a policy, a life insurance policy on his daughter, right? Now he dies before. The daughter's still alive, but the policy is still good, but he dies before, and he was the owner. So the policy, you can hand down the policy to your, whoever you want to give it to. You can pass it on, and it's still going. The policy can still be good, it's still going, because the beneficiary, the insured person hasn't died yet. So the policy is still good. It just, you have to pass it on. You can pass it on, and then the daughter eventually takes over it. And she's taken $150,000 out of the policy until she dies, and then she leaves a death benefit of $2 million, $2+ million, because they were paying $20,000 of premiums for several years. So that's how this works, right? Yes.
Stephanie was asking if she couldn't have her own policy, she couldn't fund it.
Yeah.
So they could go, this is impractical for my.
Well, the ideal thing is you want to start out with your first policy. Ideally, you want to insure the primary breadwinner, right? You want to insure yourself. And you want to insure, the first policy, you want to be able to max it out as much as you can, because that's what's going to be compounding interest the longest, right? So pay as much into it as you can. Now, what they talk about is eventually at some point your need for finance will expand, and you're going to start wanting to take out more policies. Now, but you may not need to for a while, because it does take time to build up a policy as well. But that's the thing that you have to work out, because you have to you watch out for your situation. Like, you may not be insurable, or you may have a lower health rating, or depending on the health rating, you might have to pay an extra charge on your premium. And that charge doesn't go into your policy. That's a charge that you have to pay the insurance company because you don't have a good rating, right? So all things that you have to take into consideration. The insurance agents will help you deal with that. They'll help you work out whatever the best plan is that works best for you all. They'll help you put it together, a plan. I'm just giving you sort of a rough, based on my experience with them, but they're really good at helping you put that stuff together. Yeah.
So, if I get married, but
Mhm.
I already started, my own policy, can my husband have his own policy?
Yeah.
Okay, so we can have two separate ones?
Yeah.
Okay,
Yeah. You can have as many as you want, really as many as you want, as many as you can afford. It's just the main thing is you want to start out. The first policy is like your foundation. That's your foundational policy. So the first one that you start out with, you want to make sure that you start out with a good one that you can solidly pay into enough so that it builds up. It's like your first bank, right? And then that's what he talks about when you become a franchise. When you expand, you open up other locations, right? So when you get another policy, it's like opening up another bank location, because now you're,
Take a loan out of that
and you can take more.
foundational policy to
Yeah.
fund another policy.
So you can,
monopoly.
yeah,
Also,
Like monopoly.
yeah.
I get one
It's like
for-
you literally,
for me, Milani, and
Yeah.
her,
yeah.
and we pay like $100 each or
Mhm.
something like into it, or 200 each.
The best
And
thing,
take out, like in the future, like in
Yes.
2 years, I can take a little
Yes.
of hers, mine, or hers.
Yep, exactly.
That you start off with yours. right?
But you don't do it at the same time, yeah.
And then when yours is getting like in 7 years, then you take a loan out and you get one on Stephanie and Milani with that loan, right? And then they have their own retreat startup.
But what if I die, they die before?
It depends. It depends on your situation. A lot of it depends on your situation and what you want to do. Because again, if you're going to take out multiple policies, you're going to have to distribute your premium to the 2, 3, whatever number of policies that you want to distribute, right? So with my but if you have a lower health rating, then it may be more better to have more than one policy. That's what we're looking at. Like I might have one for myself and for my wife, so that because if my health rating is not that good, then it may be more advantageous to pay more into somebody else, a policy for somebody else, right? Because of the charge. There's a premium, there's a charge that you have to pay.
You basically have to commit to these premiums, like
Yeah,
whenever
you have to,
commit
yeah.
with
And
that
so,
every month.
Yeah, but you can always bump it up too.
so the thing is, you need to make sure that you can pay into it solidly for a number of years to the point where it'll start paying for itself, because when you, if you're not able to pay the premium, and now there's a minimum amount and a maximum amount that you can pay. Like Nelson, he gives the example of the uninsurable guy. He pays $20,000 of max possible premiums per year. 10,000 of those are base premium that you have to pay. Another 10,000 is paid up additions, which you can pay extra premium. But you have to pay at least 10,000. So whatever the minimum amount is, that's the amount that you have to pay, because if you don't pay that minimum amount, you will have to forfeit the policy. And then you'll lose everything. Like you'll have to forfeit it. So you have to.
put a lump sum down?
No, well, you can pay for it different. It's like any other insurance. You can pay for it quarterly, yearly, or monthly. Now, if you pay it yearly, you get a discount. So that's part of what it's the advantage of paying. See, that's why it's good to save. Start saving up money, because it's very good to help you to pay for insurance, because they always give you a discount when you pay it in bulk throughout, for the year or whatever. Yeah.
So if you stop paying it, you lose it.
Well, it depends. If you've paid for it long enough to the point where your dividends are paying for the policy, then you're not losing it, because the dividends are paying it. But you have to reach long enough.
Match it?
You have to get to a point where the dividends that are being paid back to you are high enough to pay for the policy, right? So that's where you have to, it's going to take time depending on how much premiums you're paying into it and how much the dividends are paying out. That's where, but if you get a good system going for, if you pay it high enough to start out with, in a matter of 7, 8, 9 years like that, you'll be able to start really not have to, your dividends can start paying for it. That's the beauty of it, right? So that's what makes it so powerful. The fact that it's tax-free as well, totally tax-free. I mean, it's such an amazing. It's hard to describe how much better it is to use this than to use all the schemes and scams that all these people are pushing. This Dave Ramsey stuff and all these other guys.
But they can't get a loan out for your car. You can't repo your car. You get to keep your car. And the death benefit pays it for itself. And then maybe in 2 months, you have to control it. Oh, shoot. I had this happen, so I can't afford it. And then next month you got a surplus and you're supposed to make another payment. You allow that to yourself, right, to the loan. If you want to pay the loan off, which is good, because that money is going into your dividends. But you're not going to get your car repossessed, you're not going to get your home, because it's your collateral money. You don't have those.
If we paid off, take it from the benefit.
Yeah, and a good way to look at this is that if I were to put my money, so life is all about choices, right? If I were to put my money somewhere, what would be the best place to put my money? Now, there's different things that you have to look at, but if I wanted to put my money somewhere, one of the best places, if not the best to put it in, is a life insurance company. Because life insurance companies have survived. They survived the lockdowns. They survived 2 world wars. A lot of these companies have been around for over 100 years. And they are still standing. And when soldiers went off to die, they had life insurance policies and they paid them out to the beneficiaries. And they're still here because they are the most conservative companies that will really secure your money. It's really the best place to put your money. This is what banks should have been. Banks should have been this way. And sadly, they are totally corrupt and controlled by the government. But this is what a bank should be like. It should be more like the way life insurance companies work. You know? Now, you still also want to take a look at precious metals and being aware, like what I mentioned, step 3 to 6 months of expenses. If you have things like that you can take advantage of as well, because there's going to be a massive surge, very likely, in the value of precious metals. It's already been climbing like crazy. Gold has skyrocketed already, and it's going to continue to go up. And like we've already talked about, the reason it's going to keep going up, how do you know? How can we tell that it's going to keep going up? Exactly, because governments keep printing money like crazy, and that's going to continue to drive the value of precious metals up and hard assets. So it's good to be wise, plan things out, pray about it, discuss things with your family, and see what you can do to take advantage of these things, right? And really seek to do that.
Is there a minimum amount? Do they require a minimum amount? Like if the income of the person is $30,000 a year.
For what?
Do they advise you?
For what, life insurance?
Huh?
For maybe, I'm not sure, but yeah, in order for it to work effectively, you have to pay a good premium into it. Otherwise, you have to wait much longer for it to become effective.
Well, like you gotta put, in order like to get a head start, you have to put a chunk down.
Well, no, that's not really how it works. So
What do you mean by premium? You have to put
a premium, no, I mean you have to pay a good premium, like not a lump sum in advance. That's not how infinite banking is designed to work. But if you do get a life insurance policy, like one really good thing, like a nice way of going about it is like, say the grandparents want to open up a life insurance policy on the grandkids. Those life insurance policies are very effective because a child is very insurable. They're not expensive to insure. And it can be a low premium, a much lower premium, because you pay into it for 20 years, and you have a really well-maintained, very efficient policy. By that time, the policy is probably already paying for itself. And that's the beauty of starting like one for children. But again, you have to look at your situation, because when you're insuring somebody, you're insuring their death. And the goal is you want to insure the primary breadwinner first. That's how life insurance, that's how these guys work. They recommend that. You want to insure the primary breadwinner first, and then work outward from there. Right? So, all right, good. Yes?
So I've had a 401k for 3 years. So if I want to open like a life insurance, would you recommend me taking everything out of my 401k?
Oh, man.
But she's only had it for like, how long?
4 years? Yeah.
So she shouldn't have that much.
What I would strongly recommend is for you all to talk to the insurance guys to see what they tell you. They can probably give you a better action plan for how to deal with that. And you can also talk to Dr. Kirk Elliott, because they can also advise you in potentially having a gold-backed, precious metals-backed 401k. So you can look into, you can get both their input from both of them and see what works best for y'all. Because it may also depend on how much money you have in there. You just want to make sure that you can. It's probably not a good idea to take it out, depending on how much it is. It's just not a good idea to, you just want to be careful not to be aware of the consequences for doing that, right? So it's good to ask them. I would definitely ask them, both of them, to see what would be worth doing. Yeah. Mm-hmm. All right. Thank you all. This was really good. I appreciated the questions and the interactions.
Oh, so like what if what if the World War III happens and Russia or China ends up winning and they take over the United States, so now they're in control, or any other country is in control now. Now the United States is no longer the United States. It's in their control. So what would happen then?
So it's funny.
Because we're not doing the vacancies, but what would happen to the life those companies if Russia or some other countries took over?
Have you heard of the golden rule?
No.
What's the golden rule? Y'all know the golden rule? Right, amen. Treat others the way you want to be treated, right? There's another golden rule. And Nelson talks about it in his book. The other golden rule is those who have the gold make the rules. Those who own the gold make the rules. Guess who has all the gold? China. China has all the gold. If you look at the amount of precious metals that countries have, China is number one. So we're already there. We're already there. We're already slaves to China because most of our products, most of our medicines are outsourced from China. And that's a bad place to be because we are relying on them for stuff that we used to not have to rely on them for. And that's the big that's one of the things that Trump did a really good job of exposing when he started becoming more public office, running for president stuff. He was calling attention to all this China stuff going on. That we're already there. They own all of it, practically.
So if they wanted to, they could change that system now.
They're already starting to do that. They're already starting their own financial system because the I have to watch my language with Biden, but the utter fool, this administration decided to take Russia out of the payment system, the swipe, what is it called, swipe, the American dollar-based system. So now they're getting into a system with China. I mean, utter stupidity from our administration. Yeah. Yep. Yeah. So we're already there because those who have the gold make the rules.
So once that happens, what happens to our life policies once that happens, if that happens? The thing is, with life insurance. So with life insurance, that is something that you have to consider because it's based on the currency, which is the dollar. So with respect to that, there is a certain risk. It's a very low risk, but there is a risk. What's probably going to happen is that they're going to change out the currency again. They're probably going to try to make a digital currency because that's going to enable them to control you even more, us even more. They can put money in if you get a good social credit score. They can take money out if you're saying things that they don't like you to say. They can just they can already, but it's so much easier to do because with cash, they don't know what you're using with cash. They can't control cash. Yeah. So but the life insurance companies will just switch over to whatever currency is being used. But there is another risk to that. So you have to be careful and plan for those scenarios because there is a possibility that everything can go under. Now, the ones that are least likely to go under, though, are life insurance companies. They are the most resilient. Yeah. Because that's your banking system. That's exactly. Because you use that to finance other opportunities like precious metals. Exactly. That's how it works. It's your own banking system. That's exactly how it works. Now what happens if they infiltrate and then they take your gold? Yeah, you have. That's another risk that you have to be mindful of. That's part of the trade-off of. And Dr. Kirk Elliott, they'll talk to you.
We'll be hiding under caves.
Yeah.
There'll be churches underground.
Yep. They'll talk to you about that. There's trade-offs. There's trade-offs between you keeping it at home or you having it in a vault. There's trade-offs that you want to look out for and be aware of. So we'll talk more about that next week too. But thank you all for your attention. Thank you for listening to the sermons of Thorn Crown Covenant Baptist Church, where the Bible alone and the Bible in its entirety is applied to all of faith and life. We strive to be biblical, reformed, historic, confessional, loving, discerning Christians who evangelize, stand firm in, and earnestly contend for the Christian faith. If you're looking for a church in the El Paso, Texas area, or for more information about our church, sermons, and ministries such as Semper Reformanda Radio and Thorn Crown Network podcasts, please contact us at thorncrownministries.com. And may the mercy, peace, and love of our triune God be multiplied to you.